Welcome. Can you hear us
Thank
okay?
you. Yes. Good morning, everybody. Thank you very much.
All
Happy
right.
to
Well,
be
I'll tell you
here.
what, Ed, I'm going to turn things over to you because you're actually the moderator. You can introduce the team. Alex is up here on stage. I'm going to leave the stage and turn things over to your capable hands. Thank you for joining us, Ed.
Thank you very much. Really appreciate it. This is going to be a great event. I'm really impressed with the venue. That Military Institute looks great. But I'd like to take this time to introduce our panel. I see Alex sitting there with some empty chairs next to him. Wish we could be there in person, Alex, but unfortunately we have to do this virtually, but we're still really excited to bring you this information. So yeah, you see Alex Ngaki, who's sitting there from SVN Rock Advisors. Thank you for coming, Alex. We also have Jeff Abramchek, who is a managing director for Exemplar Law firm. He's a consultant specialist for securities law as well as for blockchain law. And he's also our lawyer. So we appreciate Jeff being here. And then last but not least, Graham Moore. Graham is the head of tokenization for Polymath Networks. Graham and I go back through 2017. Graham, welcome. We're looking forward to all the interesting things you have to tell us. So let's kick this off. I think we have a presentation of slides we're going to show. I'm not sure if they're ready yet. But we'll start with the first slide. So we're going to just kind of walk you through some of the basics of tokenization. If I have to bring the slides, I guess I'll find them, but we have the slides ready to take a look at, guys.
I can try to bring it up. Hold on one second.
I have it too.
Yeah, you're up.
Okay, good. So really, we want to just kind of talk about the foundation of tokenization, which is really a simple concept. Tokenization is just taking any hard asset and digitizing it into fractional units and putting those fractional units on the blockchain. So it's a way of showing ownership of hard assets on the blockchain. And you can see that people have tokenized art, have tokenized classic cars. I mean, you want to tokenize really assets that are going to appreciate in value because it makes more sense when you're transferring. But you can really tokenize anything along this line. And I'm going to show you really how things are done. But there is a distinct difference between security tokens, we call it STO, security token offerings, and NFTs. Security tokens are going to be assets that are actually income producing. And the SEC considers all these income producing assets like stocks or real estate to be securities. And so we address them that way. But NFTs, which are non-fungible tokens, are actually digital assets that represent also a durable product. But the difference is the NFTs are not security tokens. And we're going to go into more definition about that in a few minutes. The reason why we like, you can go to the next slide. The reason why we like real estate tokenization is because it is a security. We are digitizing an asset that is not only income producing, but also has potential for capital gains. So if you can look at this like almost like an IPO of a piece of property, we would take an asset and create digital shares of the equity of that asset. If there's debt involved, the debt can be also tokenized, but right now we're just focusing on the net equity. So you can look at it like a share of stock, like this Apple share of stock you're looking at on the screen, that becomes digitized. So all the rights and privileges of that Apple share of stock are now transferred on to a digital token. And this is what we think the world is going towards, to digitize assets. But the value of the digital token is represented by the intrinsic underlying value of the asset. Next slide, please. So the process is not very complicated, although there does touch a lot of legal work as well as technical work. We pretty much try to identify the ownership of the assets. We know who owns it. We also do evaluations. So we know the value of the asset. If there's any debt involved, we subtract the debt. So we're really looking at the net equity on this asset. We then take that net equity and divide it by either a number of shares, by either using square footage, or in this case, we like to use a dollar value. So we take each if a $50 million asset that we're trying to divide, we create 50 million shares. Those shares are now put on security and custody with, in this case, our partner, which is Coinbase. And from there, we're able to issue these shares to investors who are looking to invest into this project. All this is regulated by the SEC and FINRA, and we follow all the necessary guidelines and procedures that the FINRA members request of us. But this is really a way for equity on expensive projects that are usually Class A or Class B projects to be broken down into more affordable chunks for investors to participate in. So someone with 1% or less than 1% has same equal rights and distribution as a person who may control 50% or even 90%. Next slide, please. And so there's a lot of value. I know there are a lot of apartment owners and developers in this audience, and that's great because that's happens to be my area of expertise as well. I worked with Cushman & Wakefield for 19 years in commercial real estate, especially focusing on multifamily development sales on the capital markets level. But these are the really nice benefits I think that property owners should be taking a look at. One is that you have a lot of equity in your assets that's locked. When you buy an asset and you start to add value to it, your equity is growing. So if you have a $100 million asset with $20 million worth of debt, you're sitting with about $80 million of equity on that asset. And that equity is actually locked up. And in some cases, there's an opportunity cost that's lost that you're not able to move that equity into something else. And so this is an opportunity for recapitalizing the equity out of your asset. It also allows, a seller, an owner, not to sell their properties too fast. A lot of times, developers build, stabilize, and sell because you're up against the clock with your debt, as well as your investors are looking for a quick turnaround in 3 to 5 years. But sometimes those properties aren't really seasoned enough to sell to get the maximum value. And so this way, you don't have to sell the project. You can recapitalize your equity at a market value and keep moving as GP. And let me just talk about that a little bit as well, because typically GPs are looking for their earnout share when you sell the asset. That's when you really make most of your profit. But in this case, if you recapitalize 90% of the equity in your asset, your earnout is now based on dividend distribution annually. So as you're improving the value of that asset, you're improving the dividend distribution. And so anything above the initial hurdle rate that you established with your new LPs, you're now splitting pro rata, whether it be 70-30, 50-50, year after year after year. So I think you guys can see that this is a much better and more profitable arrangement for a GP than to sell the asset off and have a one-time earnings that you're going to move over to another asset, but then you lose the opportunity from that asset going forward. So this is why we kind of like tokenization. Also, there's 2 other factors that you should know. One, we allow cryptocurrency owners to be able to invest in real estate. We will accept their crypto. We don't take exchange risks. We'll take the crypto, quickly convert it to a US dollar denominated digital asset, which is called like a USDT or USDC, and then credit that to our customers. So they're getting dollars, not crypto, but it does allow the pass-through construct for cryptocurrency holders to be able to buy in, which is very important with the amount of cryptocurrency growing around the world. And then finally, it'll allow for any Wall Street or family office type investors also to be able to invest directly into your asset. So with this, I think this is the last slide. I'd like to kind of go into our illustrious panel and ask some questions amongst our panel to get some feedback from our members on the panel. So I'll start with you, Jeff. In terms of regulatory, what do you see are the requirements for regulatory on issuing STOs for building developers?
Yeah, so thank you so much, Ed. And also I want to thank everybody for the opportunity to speak. A couple of things. What you have touched upon is these are securities. Securities laws from the US apply, and also in Canada, the expectation of both the Canadian and US regulators are that you follow the securities laws as opposed, which apply to the issuance, which is creating the security itself. Typically, buildings of this kind are privately placed in the US. You have comparable regs in Canada. So it's a private placement memorandum. It will undergo normal due diligence in terms of investor status. Typically, accredited investors would actually purchase these securities. And then from a tokenization standpoint, what Ed is pointing to is the security tokens are equivalent to earning shares in a stock. So they are afforded the same regulatory framework that you see in respect to purchasing traditional securities. So what's important is that the people you deal with when you purchase security tokens have the expertise and also are properly regulated. So, and there are various components to this. Typically, there's a broker that would be involved in terms of placing the security tokens. There'll be a private placement memorandum that's issued, which is provided as full disclosure in terms of what you're investing in. That's the securitization side. That also undergoes a process with traditional private securities investments or alternative investments. That also undergoes a subscription process. Tokenization is the issuance of the shares. It also provides something which is unique, which you don't see with traditional settlement processes, both in Canada and the United States. It affords the fractionalization and unlocks liquidity. And then for secondary trading, which is a very important component of this, at least from a US standpoint, typically private placements are subject to a lockup for 1 year. The security tokens themselves have the logic in order to comply with these requirements that typically are coded into the token. And then from there are venues which afford secondary trading in the US to call alternative trading systems. From a Canadian perspective, it's roughly equivalent to the exchanges or what they do. And these transactions will actually have unlocked liquidity. Whereas traditional private placements in real estate, as Ed had pointed out, to typically have a long holding period and also force basically the developers to actually undergo liquidity events, which are usually may not be more beneficial than having a security token. So this is a sea change from both the US and global perspective. The private securities area for real estate is perhaps the largest component of investable private securities globally, and real estate offers, this can unlock trillions, literally trillions of dollars worth of investable real estate.
Jeff, while you're explaining that, thank you very much for making that extremely plain for everyone. But can you also tell us, the basic documents that these owners will have to create using to stay within the regulatory rails of tokenization?
Typically, it's a private placement memorandum or some sort of securities offering document, which complies with your jurisdictional requirements. The United States has a harmonized approach from the SEC standpoint in terms of what the expectation, what the documents look like. And this is similar to any other type of private securities investment. There will be a subscription documentation that's provided, which actually discloses not only the PPM, but other terms associated with the investments. And what is also equally as critical is knowing servicing of the tokens and who your token provider is. That's usually provided as part of the subscription process. And also how ultimately you can unlock your liquidity for secondary trading. So typically you would know as part of the subscription who is going to be the venue in order to afford transactions.
Thank you, Jeff. There's been a lot of talk, and you see a lot of literature from people saying that they're using NFTs to actually create fractionalization of real estate assets. And there's a big distinct difference between the NFT and the security token. And so, Graham, I'd like for you to explain really the fundamental differences between the NFT and the also the STOs.
For sure. Thanks, Ed. Bye, everybody. So in terms of NFTs versus STOs, so STO security token offering, NFT non-fungible token. So in terms of most of the things you talk about when you're trying to invest in equity of a piece of real estate or even equity just in general, those will be fungible, right? One piece of equity equals one piece of equity equals one piece of equity. But then on the flip side, there are now these things that we can create with tokens called NFTs, so non-fungible tokens. So one token doesn't necessarily equal a different token. So typically the offerings that are happening right now that we were just speaking about, that Jeff was talking about, and that RedSwan's primarily doing, you'll buy equity in this building and one share of this equity equals one share of the other piece of equity. But what we're starting to see and what's being explored now is, okay, well, what if I could buy the title to a house or the title to a piece of land, right? So that would be non-fungible. That title of land doesn't equal another piece of land, so it's unique. It's non-fungible. You can't interchange it with another piece. And so we're starting to see that start to take off as well in the sort of blockchain space with tokenization, is purchasing these unique things that are different from others. So maybe you could buy unit 7C in a building, which is obviously unique from unit 7D. And then those things, they wouldn't necessarily obviously be the same trading value, and they're unique offerings. But you could still have those NFTs sort of be represented as securities, obviously, because you're purchasing them with the intent to receive the cash flows from them. You're purchasing them because you think the value will go up and you're hoping to sell it for a profit in the future. But it's really cool to start seeing these different representations and these different ways that we can represent value on blockchains, especially with real estate, which we're seeing as kind of the one big thing that's really taking off in the space, really with RedSwan, with a few of these other players as well. And it's really cool to have, the option to have a complete house that's unique, that's non-fungible, that's different from another house, or a land title or a mortgage title, and then also being able to invest more typically like you would in a stock or a bond, where you can buy 20% of an asset or 5% of an asset using these individualized shares.
No, that's a great response, Graham. And I think, on a practical level, RedSwan, we're actually doing both. We're creating STOs, which are actually used to raise capital for the sponsors, but we're also creating NFTs for the assets. For example, some of the hospitality products we're coming out with, they create NFTs because they want to use these NFTs as gifts, as a VIP status for people who are investors in the hotel, get additional benefits by holding on to the NFT. So it's almost like having two digital assets out of one. But I like to really kind of touch on, Graham, what are some of the protocols that are available right now for people to use to create STOs?
So one, obviously, that RedSwan has used would be ERC 1400. So if anybody's familiar with the blockchain space, you might have heard of Ethereum. And so I work at a company called Polymesh. Originally, I worked at Polymath. So Polymath developed and spearheaded this tokenization standard called ERC 1400 back in 2018, where if you know what ERC 20 is, that's the standard that a lot of tokens are created on. So maybe you've heard of Shiba Inu, or maybe some other protocol tokens like Uniswap or SushiSwap. A lot of these tokens that were being created use the ERC 20 standard. And then what we said at Polymath back in 2017 was, okay, people are creating tokens on blockchains. Clearly, people like these things. You can trade them globally. They're very liquid. You can trade them very easily. You can create them very easily, but there's no concept of regulatory compliance. So what we said is, well, how do we make sure that we could follow a Reg D offering or a Reg S offering or a Reg A plus? How can we make sure that we can use these things for actual securities? Well, you have to build the compliance criteria. So we started building things like whitelists, where only certain addresses are able to hold and transact with this token. Doing things like restricting the number of investors that are able to participate. So for a Reg D offering, for example, in the States, you can have up to 2,000 investors. So how can you limit that number of investors on chain? So we were building all of that technology. And part of what that was called was that tokenization standard ERC 1400. And then what we noticed as we started building more and more, and especially talking to the world's largest financial institutions, the Goldman Sachs, the JP Morgans of the world, is there should be an infrastructure that's built specifically for these things. So Ethereum is general purpose. You can have NFTs, you can have STOs, you can have kind of anything to your heart's delight. You could have social media platforms and whatnot built on Ethereum. But we said, okay, well, there should be something specifically for securities. So we started building our own blockchain called Polymesh. And so that actually launched late last year. And so that I would say is where we're hoping to see a lot of development happen and a lot of more uptake in these real estate specific securities, where there's now a blockchain, an infrastructure, an ecosystem specifically dedicated so that people can easily follow the regulatory guidelines that they need to follow. They can easily create and manage tokens. And it's also more cost effective that way as well, when the infrastructure is specifically built for one thing rather than general purpose built for all things to all people.
Awesome. Thank you for that, Graham. You know, a lot of people have asked me, and I'm sure that a lot of the developers in this room are wondering, why do I need to use tokenization to raise capital? I have a lot of institutional capital that's chasing after my deals right now. Why is it important for me to switch over to the blockchain and use tokenization? And what I usually say as an answer is that, you know, the world is changing and everything is going digital. And you can look at cryptocurrency, even though it's kind of down right now, it has approached up to $3 trillion in the M1 supply and probably will continue to grow. And so that is a market that you can't be really ignored. But when you look at the kind of capital you're bringing in right now from institutions, we all know that sometimes that capital has a lot of strings attached to it, some sharp teeth. You know, a lot of times the mezz capital and the equity kind of manage and control the deals, even though the developers spent years and years putting these deals together. And we look at it like this: if you don't open your arena for additional retail kind of capital to come in, as more and more people are moving into digital assets and they're able to have the ability to have secondary trading so they don't have to be locked into their investments. So if they start to compare, for example, a office building in downtown Toronto that's you know, raising $20 million, and the sponsors have the traditional route where you're locked in for 5 to 7 years versus an identical project across the street, same value, $20 million raise, but these investors are not locked in at all. If they're Reg S, they get to trade immediately. If they're Reg D, U.S. citizens, they have that 12-month seasoning period. You're going to find more people going after the capital that's more liquid, that they have an opportunity to exit if they want to. And if you're not offering that, I think you're going to start losing a lot of investors because they're going to go to where they have the biggest advantages. So we think that it makes sense to start building your brand around investors who are looking for you know, capitalization of projects like yours. And that way you kind of have a following of investors that are on a retail level that will crowdfund into your projects time after time, which I think is a lot better than having just one or two institutional sources of capital. So that's kind of the reason why we think it makes sense to start, you know, planting your seeds right now and getting involved in tokenization because it really helps you build that brand and generate a lot of investors who typically would stay away from commercial real estate. One, because the price point is very expensive, sometimes $250 to $1 million to get in. And now the price point has been reduced down to as low as $1,000. That makes a huge difference for retail investors with whether or not they want to put their money into a project. And the second aspect, like I mentioned before, is that liquidity aspect, them be able to exit quickly, with whether it be 12 months after 12-month waiting period or for Reg S immediately. That's a major advantage for investors. So I just want to throw that point out there, but you've talked about some of the regulatory changes between the US and Canada. Jeff, are you seeing more and more countries now kind of follow the US regulatory process so that you know, people, we can feel comfortable that following the regulatory with the US would really be the kind of guideline of regulatory around the world?
Yeah, so if you look at it globally, I mean, I will turn to the EU and what's going on also in the UK, and you know, be mindful there's Brexit going on, but there's still a lot of alignments and regulations. The EU is actually a little bit more forthright. There's been a lot of good guidance in terms of how to navigate crypto in general, and also a focus on security tokens as well. So it's not just a US/Canadian phenomenon, it's actually a global phenomenon, what's going on with tokenizations. The key here is to align with regulatory expectations of current securities laws. And then, as Graham has pointed out, to adopt technologies such as Polymesh, which actually embrace the actual data points that are required for the tokens to actually comply with the requirements. is a combination of the proper private placement process, if you will, of the securitization process, plus proper technologies and controls, get you to a sea change here in terms of unlocking liquidity. So embracing compliance and regulatory frameworks in conjunction with the technology is the way to go.
Thank you, Jeff. We've been focusing a lot on the tokenization of equity. I know that's what we started off with RedSwan, but I see a lot of interest in tokenization of debt instruments as well. Graham, I mean, because you've been helping with tokenizing a lot of real estate projects, can you kind of touch on what you're seeing with regards to tokenization of debt?
Yeah, for sure. I mean, that is, the big behemoth, right? Obviously, equity is a certain portion of the world's economy, and there's trillions of dollars of equities, but debt has always dwarfed equity in terms of the amount that exists out in the world, and so we see that as the next most likely progression. So there's also a company that we work with, not on the real estate side of things, but they're a company in Australia that's tokenizing debt offerings and offering those to their investors. And so we see that as the most next logical step. And, we've talked to a few banks as well that are always interested in the debt side of things. For equity, for them, it's interesting. It's nice. Vanilla, common stock being tokenized is cool. But for them, the origination costs around debt are so large. And these offerings are, 100 million, 500 million, $1 billion, $5 billion. And so when you can bring the origination cost down on a debt deal that's that large, it becomes really attractive for them to start looking at this new technology space. Whereas before, a $10 million equity offering, they go, yeah, okay, you know what, we'll just keep doing what we're doing. But, you can bring down the cost 90% on something that we were doing that was $5 billion. Okay, now this starts to get really, really exciting. So I think it's just the magnitude of debt that is really exciting a lot of these big institutions to look at this, especially for the real estate space.
How are you seeing banks getting involved? Are they being very supportive of the tokenization, Graham, or what are you seeing some of the issues around surrounding banks? And I'll chime in afterwards.
They are the slowest institutions in the entire world to adopt anything. So it is amazing that some things are even happening. So I think there was this sort of watershed moment that happened about a year ago, where there's a bank called SocGen. Some people might be familiar with it. It's a bank in France. And they actually created a token on Ethereum that represented, I believe, $100 million bond. And then they engaged with something called the MakerDAO protocol. If anybody knows what stable coins are, there's this one stable coin called DAI, which is built on the MakerDAO protocol. And what SocGen is doing, and what they actually pledged a vote to do with the protocol, is to offer that bond, a $100 million token that exists on Ethereum, as collateral in order to generate a loan in DAI, which is representative of $1. So that was the first bank to do something really, really exciting like that I've seen on a public open blockchain, where they've created a security token, and then they're pledging that $100 million security token as collateral in a decentralized protocol. So DeFi, decentralized finance. And so we're finally starting to see that happen. We're talking to a number of banks around the world who are looking to do this as well. Now that they've seen, wait, one of our friends, and not really friends, one of our competitors and enemies was able to do this. They got this past their compliance department. We need to figure out how to get this past our compliance department. And that's the comment we hear all the time is, it's cool. We got to get it past our risk people. We got to get it past our 1,000-person compliance team. And it's finally starting to happen. We've been having these conversations with banks since 2017, where they would take our calls sometimes, but it was pretty much, okay, cool, call us back when something's real. But now all of their competitors are starting to jump into the space. We're seeing it with real estate. We're seeing it with debt. We're seeing it with pretty much anything under the sun. And they're starting to see their competitors gain more market share and more clients and more assets under management. So now they're starting to take this very seriously, and they're ready to go to the next step.
Yeah, that's very interesting. On a more practical level, we're seeing, we've tokenized about 28 different real estate assets now, and more keep coming on. But we're in every instance, we have to review the bank note document to understand what those legalities are. And what I've seen is that most of the banks, whether it be Fannie, Freddie, the agencies, any type of a loan that's not securitized, seems to be okay with tokenization, as long as the sponsors with the GPs, who are the ones signing off on the note and the bad boy carve outs, are staying on board and not liquidating their interest. they're okay with selling out the interest of the LP investors. So we've been seeing no problems with recapitalizing smaller investors, so long as any of the investors that are coming in don't buy more than 20% of the shareholder value, because if it goes over 20%, most of the banks would like to review and vet that new investor, just because they think that overall they have some influence over the management. But if they're under the 20% threshold, there doesn't seem to be a problem with the banks. Secondly, we found that CMBS, on most of their notes, they have language that shows that if you are changing out more than 49% of your LP investors that you started with, it has to meet their approval as well. So CMBS is a little bit more strict because of the fact that they're securitizing that debt and they don't like changes too much, but it's not impossible. But you guys know when you're dealing with CMBS, it takes a long time to get decisions. But if you're tokenizing less than 49%, typically you're okay with a CMBS type loan. So those are kind of the benefits and also some of the issues we've seen on tokenizing real estate projects that have commercial conventional debt as well as CMBS debt. Alex, I don't want to leave you sitting there by yourself without saying anything. I know that you've got a lot of constituents in the marketplace, and I'm just want to talk to you about how brokers are getting involved. How do you see brokers getting involved in tokenization and digital assets as it relates to commercial real estate?
Yeah, good morning, everyone. I think that brokers will continue to do what they've always done, is find people who have assets that they want to sell to people who want to buy those assets. That's not going to change. We're going to continue to operate in much the same way, focus on marketing. And this is just another service that we can provide to both these parties, to investors and sellers, to combine the two worlds as we normally do. I think that SVN continues to push boundaries on what kind of avenues we explore, and this is like a testament to that, we're looking down this avenue. And yeah, I think we'll just continue marketing to the same types of people, and we're going to have to alter it, but we're going to have to stay on top of it for sure.
I totally agree with you, Alex, that right now it makes sense for your clients to have multiple options for raising capital. There are definitely the traditional options they've gone to, which is what a lot of the institutions. But let's just say that some of those options are drying up. The last time in 2008, a lot of the financing options froze for a while, and transactions didn't get done. We had very little liquidity. But having a secondary option by taking on retail investors, I think, is an additional tool in your quiver that you can use for your clients, because it allows you to help them get their problem solved. So I definitely agree with you that brokers are going to get deeply involved in, if nothing else, referring these opportunities to groups to tokenize. And then also, I believe that it's always important to have feet on the ground when we're tokenizing assets. We want to know the market. We want to know the feasibility of the project. And brokers are invaluable for that. I used to be a broker myself, so I know you have very strong insight on what's going on in the market, who are the leaders, what are the competition coming in. All this is important in terms of determining a value. So I think brokers are going to be extremely helpful for us and for the clients in terms of defending the value of the assets in the marketplace.
Yeah, and just to touch on that, I don't think that every asset will be good for tokenization. So it will take someone who knows a little bit about both worlds and client expectations to match those up properly as well.
That's very true. And also on the debt side as well. I mean, we didn't focus on tokenizing debt just because, debt right now is a commodity, but we are looking very closely at tokenizing, or financing, I should say, mezz debt, which is probably the second most expensive capital in the capital stack, using digital assets. So we think that there's a very good market for tokenizing or financing mezz debt through digital assets. And again, that's another tool that you can have to pass on to your clients if they're looking to try to put on new debt and they need to carve out 10 or 15% of a different source of kind of a pref equity. They might want to look at some of the sources in digital assets. Well, thank you for that. In terms of the secondary market activity, there are probably some questions on how is this liquidity going to take place? How are investors who are buying in now going to be able to get out, and what kind of market is there for these investors. Graham, maybe you can talk about the liquidity side on the secondary market for a few minutes.
Yeah, for sure. The liquidity is coming. It's there in a small way today. For a lot of these different projects, there's one interesting project called Realty, where they actually just allow all of their investors to trade on a decentralized exchange called Uniswap, which lives on Ethereum. So any investor can essentially sell to any other investor in the entire world, anywhere in the world, as long as they've been approved onto Realty's whitelist. I know RedSwan is doing some exciting things in terms of secondary liquidity with potentially, making their own marketplace or something like that. I'm not sure how much I'm allowed to say, so I'll leave it there. I'll let Ed comment further. And then there's, of course, other exchanges that are more general. So there's one called T0, which people might be familiar with, which is a sub of overstock.com, where T0 has very, very different assets that live on the marketplace. Real estate assets could live on this marketplace. I think I've seen maybe 2 or 3 different real estate focused secondary liquidity markets start to pop up all around the world, Europe and Asia. And so the liquidity is coming, it's there. Ed mentioned, trillions of dollars in cryptocurrency that exist. I think we just dipped below that $1 trillion mark, and then we just went above again in terms of that side of things. But I think the important thing here is what this does is it creates much more efficient, automated, and transparent capital markets that are completely and inherently global. So instead of in the past where I would have an asset that's in Toronto, I would probably be selling it to Toronto investors, or at least a fund with a focus on Toronto. What happens when I can open that up to the entire world? So now I can have a Vietnamese investor who wants to buy $1,000 worth of this asset. I have a Nigerian investor who wants to buy $10,000 worth of this asset. I have someone in Australia who wants to buy $50,000 of this investment. It becomes very cool to see that we can finally have this actual global liquidity on a scale where you can still maintain regulatory compliance and you can program whatever do's and don'ts you need to into your token. But we can finally have that where it's not just, Blackstone coming in and has to take the entire asset down. Or it's 2 investors that take the entire asset down as a REIT that's in Canada with a Canadian focus. So opening up this global pool of liquidity, we're starting to see it now with a few of these different protocols, and RedSwan is also one of the leaders there. And it's really only going one direction in terms of adoption, which is way up and to the right.
I totally agree with that 100%. I mean, if I look 5 years into the future, I just see many assets that are being developed by developers being held for a longer period of time, where the developers are now having more assets under management with less equity in those assets, and more shareholders coming in from around the world, buying and selling, share their position in these pricing in these profit projects. And I see also a lot of companies coming in to help with liquidity in terms of valuation for day-to-day valuations of projects, so people know kind of what the price of their shares would look like on a day-to-day aspect. So a lot of that companies are pouring into this space with both technology, but also a lot of property owners are pouring in to tokenize their assets. We started this in 2018. It was very light at the time. We tokenized probably 10 to 12 assets then. Like I said, now we're at like 29, and there's probably another 15 in the pipeline. So the industry is really moving in this direction. I'm just going to talk a little bit about what we like to tokenize, just because we get a lot of requests, and we try to focus on recapitalization of assets. That means that these are projects where you purchased an asset, you've already kind of done your value add, and the asset's now stable, and you may be thinking about a disposition over the next 12 to 24 months. That's a perfect time for at least RedSwan to come in and evaluate the asset, understand what the net equity is, and then tokenize up to 90% of that equity, so that the GP gets to stay in and maintain control of the asset, but allows this opportunity cost capital to be released and put into other projects. We also like to focus on new developments. So the only requirements we have there are that you own the actual land that you're developing on outright, so we know there's an asset we can tokenize. And then secondly, you have construction debt in place, so that we know this project is going to get done, because typically in order to get your construction debt in place, you have to have all the entitlements for your development project ready to go. And then at that point, we can now help you raise up to 90% of the equity needed for that development. So those are the 2 types of projects that we like. And we definitely are interested in any type of commercial real estate asset that's income producing, whether it be multifamily, hospitality, retail, office buildings. We're even talking to the Rockefeller Foundation about tokenizing power plants. So the gambit is wide, and there's interest is also very wide amongst investors around the world. So with that, I'm going to open up and see, Alex, if you can address any questions from the audience. We have about 5 minutes here, and maybe we can answer any questions that come from the audience. Alex?
Derek?
Yeah, so Alex, I want you to explain, like we've been thinking about this and talking about it a lot. You have to build an exchange, correct? So you've got a building and you want to sell it and tokenize it. There's got to be this exchange that exists, right? So the developer builds his own exchange, which is possible, or RedSwan is an exchange. Just trying to explain that.
Yeah, so there's maybe one of the guys would be able to answer that a lot better on the requirements for an exchange for tokenization transactions.
Yeah, so yeah, you don't need to build an exchange. There are already several exchanges that exist today. There are ATSs. NASDAQ is also building a very powerful exchange for digital assets. I think what you as a developer are more concerned about is tokenizing your asset so that it's registered in your asset's name and that you're now able to issue digital shares to investors. But those investors who ever want to get out, those exchanges and ATSs already exist for them to have liquidity.
You could go the private route and build your own exchange, but then you would be going through all the hoops and hurdles that someone like RedSwan or T0 or whoever has an exchange has already gone through. And you'd have to get all the regulations in place and all that stuff. So I think the most prudent route would be just to use someone that has an established exchange and then add your assets to that exchange.
That's correct.
What's the largest asset that you've tokenized at RedSwan, size-wise?
Size-wise, it's a $284 million development project in San Francisco Bay Area, where they asked us to tokenize $11 million of that debt. We have a new $500 million project coming up in downtown Miami, which I won't mention right now, but it's coming to be on our platform in about 30 days. It's one of the largest high rises to be built in downtown Miami. So it's a matter of, it's not a matter of size. It's just a matter of quality of asset. We typically like to follow developers who have a very good track record of experience and projects that have strong feasibility, because what we want is to make sure the investors coming in get a very decent return for their investment in the projects. But also we want to make sure that our clients, who are the project developers, also are getting a good return market value for the assets that they have built.
Any other questions?
Well, if there are no other questions, I think that
Sorry, Ed, we do have another question.
Okay.
Okay, I'll start with mine. Let's say we do a $100 million project and there's, we sell 50 million, half of it in tokens. How is the guarantee on the construction loan affected? How am I released of a portion of it, or do I have to assume 100% of the construction loan if I have investors who own tokens? And secondly, for the long term, how is the guarantee effect of a return on the investment for the investor? Who guarantees that?
Okay, let's start with the loan sizing. When you take out a loan for a project as a sponsor, GP sponsor, you're 100% responsible for that loan, and you're the one signing off on it. Your investors aren't, your LP investors are not responsible for the loan, and they don't take or reduce your liability to loan at all. They could provide more equity so that you can be paying down the loan, so you have less exposure on that project with your loan, but your LP investors are silent investors who are not responsible for the loan at all. So hope that answers that question. The second question was can you repeat that second question, Alex?
On the investment, they're investing in tokens in anticipation of getting a yield on their token annually, I assume. They're not just, right? So
yeah,
the responsibility of providing that yield.
Yeah, so there's no guarantee. Everything is on a best effort basis, so we can't put any guarantees out. I'm sure you're not offering any guarantees to your investors you're bringing in right now. and neither do we expect you to do so, but you basically give your pro forma and a feasibility. We go over it to make sure it makes sense. And you're, as the GP, are responsible for trying to meet that pro forma that you've put out there for your investment. But there is no guarantee unless, for example, you set up a structure where there's a preferred payment that you're making. And so therefore, no one receives any profit until those preferred shareholders receive their interest payment. That is something that's has a preference, not necessarily a guarantee, because the project is not making enough to pay them. There's still no guarantee on that. It's just that they do have a liability now to make sure that they get paid first before a sponsor gets their first dollar.
We have one more question here.
Good morning. With RedSwan, what is the ideal sweet spot for equity debt kind of structure a deal? You talk about 20 deals or 22 deals in the kind of sub 100 million market.
Yeah, so typically we look at deals that are financed with 60, 65% debt, and then the 30 to 40% equity we're looking at, and then we would like to tokenize up to 90% of that equity. Sometimes it's 80%, depends on the project and the location and the sponsorship. But that's typically what we're seeing. We don't want to get into areas where there's over too much debt, where there's too much leverage on a project, because that could be negative towards our investors. We rather see the opposite, where we actually have more equity and less debt, so there's more comfort and more safety and protection over the equity coming in. And then again, on the interest rates, just to give you a wide variety, but there's, we try to see deals that are maybe AAA locations that are maybe paying out a 5% yield, cash on cash dividend, and then an IRR that's in the mid-teens, low to mid-teens. That's probably going to change now with the way interest rates are trending, but that's kind of what we look at, is to make sure there's some sort of a cash on cash payout, as well as a projected IRR. But keep in mind, the IRR is just projections. The shareholder can sell their shares anytime, which will finalize their IRR. So you're just making kind of a forecast on what it would look like based on your projected growth.
We do have time for another question. Is there anybody else has another question? I think that's all we have from the audience. Ed, any wrap up that you'd like to do?
I just want to say thank you very much to SVN, Rock Advisors. This has been a wonderful opportunity to get in front of your best clients and talk about tokenization. I think that if you have any questions, any one of our panelists, you'll have our information. RedSwan is easy to get to at redswan.io. Polymath is also very easy to get to online. And Jeff will post his email address and phone number so you guys can reach us. But we're here to answer any questions you have. It's a very explosive part of the market right now. We're seeing a lot of people tokenizing just to be ready for the future. And we just think this is a smart way to go. But thank you very much for this opportunity.